What's going on, guys? SmartHelping.com here. It's 12, just about noon on a Sunday. I've been trying to do a model for the past 2 weeks. I haven't found time. I finally had a good chunk where I got this done. So, we're doing an auto repair and tire shop. I used to work for one right out of college, so I have a little bit of knowledge of the kinds of costs and revenues that happen and the logic to get to the project them. So here's the model. I'll just go tab by tab. We've got the index page. It shows you each tab's name and the description of each tab. We've also got name definitions of abbreviations. Then I've got the business overview. Here you enter the first day that you plan on starting the business, the first day of the year you plan on starting. So no matter if you say you're starting in 2018 in February or April, you're always going to put 1/1/2018 because this is going out 5 years in time, and the first year, if you don't plan on having any activity till later on, you can define that in the assumptions of the revenues and costs. So the business overview is a simple count of the main metrics. We've got, tire sales by year, auto repair hours by year, and parts and accessory sales by year. Then tire revenue, auto repair revenue, parts and accessories revenue. Total revenue, total cost of goods sold, gross profit, salaries, overhead, and expenses. Total expenses and EBITDA. So in the financial breakdown graph, we just gotta, each year you can see a summary of all of these figures, the main figures. We got EBITDA, overhead, salaries, cost of goods sold, and revenues, each year stacked on top of each other. So year 2022, you see revenue at 36 million, that's that number. Cost of goods sold at 20 million, that's this number, and so on. As we move forward, we have returns. This is more about what the cash is doing. So there's two scenarios, leveraged and non-leveraged, and no matter what, you can go to each. There's up to 5 loans, and you could define when the loan happens and all the different inputs of a loan, like the amount, the term, interest rate. That's all different on all of them. So based on that, it's going to change your leveraged scenario compared to the non-leveraged. And non-leveraged just means all cash. So it means any cash that's needed to go into the business, it's not being financed. There's no cost of that capital. So with that, you can see non-leveraged has a little bit more cash return because you're not paying debt service, but the IRR is a little bit less because you have to put more cash up front and then get paid back over time. So we've got some simple metrics here: return on investment, annualized return on investment, dollar, and annualized return on investment dollars. So this shows you over 5 years. And I'm going to put a 5-year return summary. So this is saying you're going to get back a total of $4.7 million a year, and the cost is going to be a one-time, or a total cash requirement of 5.4 million. Leverage, this is saying, well, you're going to finance some of it, but you still need capital from other sources, so you still need 4.9 million. And here's your annualized return on investment based on this cash return. So you can see you put a little bit less in, you get a little bit less back over each year, but it's not that big of a difference. Now if we were to finance the whole thing, and this cash requirement is basically saying, look, you still need cash somewhere, coming from somewhere. So if we were to go loan 1, let's put it at 6 million starting the first month. That means we the internal rate of return is negative for leverage because you're actually getting all the cash right up front. So there's no negative, and you have a $415,000 reserve basically. So after everything happens with the business activity, it's saying you'll still have $415,000 left over as a buffer. And you're getting $3.8 million a year back. And see, this goes down because you're paying back more debt service with a bigger loan over each year. Non-leverage doesn't change. Put us back to about $1 million. We got visuals. I did a breakdown of 5-year revenues. So you can see the tire, the auto repair revenue, the parts and accessory revenue over the 5-year period. So you can show the investors, you know, where your revenue is coming from, or you can see yourself based on your assumptions where the revenue is coming from. Same chart, but with the expenses over 5 years. You can see startup costs, tire costs. Tire costs is the biggest one. Startup. Then you got fixed costs, P&A. Then I also did a revenue and cost breakdown by year in this cool looking chart, so you can see how each of these categories totals change by year instead of just seeing the total amount. Then some standard, you know, we got gross profit, dollars and percentage over time, EBITDA, revenue, expenses, and EBITDA. And then the cash flow. This is a pretty important chart, even though it's last, because you can see based on your cash outflow of, and this is a leverage scenario, so this is assuming, the scenario is assuming whatever you put in these loans is going to be, this is the chart. So if you put 0 in here, you see that pops down a little bit because we're not including that financing cash flow anymore. So this, you can see based on the net cash flows every month, which are these little, you can barely see them. Let me make it a little bit bigger. You can barely see those little, that's the leverage cash flow each month. So as that changes, the accumulation changes, and you can see your break even here is June 2020. After that, you actually start finally recovering from the initial cash outlay required. Now, one cool thing is all the financing does is dynamic and changes, and if you change the dates on these as well, all the cash flows and effects of that will run through the monthly and change with it. So let's say I put, and you can put a payback. So if you pay back the loan early, you could put the month that you're paying back in the payment column here, and that would update and feed into the monthly accordingly. So let's say $500,000 we finance, but we actually don't do it until May of 18. You can see if we go over the monthly, you see May of 18 or April of 18, because I offset it by 1 month. So if we're paying the first payment in May, that means we're getting the money a month before. So I put this offset. So it's 500,000, and you can see now the debt service has started since there's a loan out now. So that's going to affect the cash flows. Only for leverage. It won't affect the non-leverage scenarios. And then we'll get to how all the logic flows through here once we finish. So we basically did all the visuals, discounted cash flow. So there's your annual revenues, your annual EBITDA, and then you've got cash flow before debt service. So this is including the one-time costs that you might, plan on spending, if you do. And then I've discounted the cash flows of that here. And this is basically supposed to be the free cash flow, non-leveraged free cash flow each year. And then, so that's discounted. And then to come up with a value, you're going to say, okay, over the next 5 years, I plan on getting this much cash back. If I discount it, say 23%, then that money is actually worth less because of time value of money. And then also the terminal year, so year 5, let's say we want to exit or whatever, you're going to come up with a value. So here I've got 28 million, which is saying it's doing EBITDA, so it's doing a 3 times EBITDA. If the EBITDA is 9, the value would be 28, and then you're also discounting that back down. So then if you have the discounted cash flow of all the free cash flows plus the discounted value of the sale of the business according to this multiple method, you're saying the 5 years the value you're creating is 20 million, and then here's just the non-leverage cost cash requirement. Now if you want to change this, you can go to revenue multiple instead, and now it's going to take the 36 million. Now revenue multiple is going to be less, say it's 50%. You give it a value there of 18, and you discount it 5 years because you're saying that's going to happen 5 years in the future. So you're at 6 million. Discounted cash flow value of enterprise. Let's see, it's enterprise. Cash flow value of 17. So before we go into the monthly and annual summaries, it's probably important to go into the revenue and cost assumptions. So revenue, I've built your tire sales, 10 main tire types, and you could have different categories of tire types. These are obviously not going to be represent every single tire that you sell, but you could put like, you know, Hankook, Pirelli, Kumo, whatever. You could put different brands there, and then you could put the months you plan on those starting to sell. So if you don't, you know, you might want to stagger things over time for whatever reason. Then you also can put the average sale price of each tire type, and then the average cost of each tire type. And so you can see your profit per tire, profit margin per tire category. And then here's the most important part, is your monthly count of tire sales for each type. So here it's saying in 2018, each month I plan on selling 200 of type 1 tires. Year 2021, tire type 6, I plan on selling 680 a month. So that's what that means, and you could put whatever numbers in here that make sense to you. Everything in light yellow is adjustable and changeable, so I would recommend when you start, you just highlight everything, hit clear contents, and then start filling in your own information. The month is going to be a drop down based on, and it will be based on your project start date that you put here, and it will go 5 years out in months from that date. So let's undo that. So we got numbers in here. So that's the tire sales, how that's going to project out. Quick test, you want to see it. So say we month tire type 5. Let's say it begins in, I don't know, February 2020. And just so we know, let's put like 1500. And let's put 1000 here. In 2020. So for 18 and 19, nothing should show up for tire type 5 on the monthly. Let's see. Tire type 5, oh perfect, zeros all the way, and then you can see, yep, February 2020, there's when it starts actually getting revenues. There's the revenue, cost related to that revenue. Perfect. And I just picked a random one to show you the logic is working dynamically. Undo that and that, so just back to month 1. So that's how the tire sales works, and it flows over to the monthly summary. From the monthly, the annual simply aggregates all the buckets, so it's just aggregating the total sales counts and then getting your revenue number from whatever happens on the monthly over each year's time. What else? So that's the tire sales. We got parts and accessories. It works the same way, it's just parts. So you got all your main part categories. I just put like body parts, electrical, interior power, whatever, you know. You can put any categories you want to separate out, the month you plan on selling those types of services. the average sale price, or not services, parts, the average sale price of each part, average cost, and then the count you plan on selling each month for the next 5 years. Repair work, same logic again, but it's transmission, oil changes, brakes, suspension. Month begins, the price you're charging per hour for each service, and then the amount of hours you plan on working or having, providing these services each month. So based on all of that, you'll then have this monthly summary, and I've got you can minimize here so you can just see like the totals of everything instead of having to see it all. So you can see tire sales, tire revenue, tire cost, gross profit per tire, and then repair hours, repair revenue, and then we've got accessories, parts and accessory revenue, parts and accessories cost, gross profit, parts and accessories. So all that can be consolidated down, and I wanted to add the costs and gross profit of each revenue source, the main three, because that's important to see, instead of just trying to consolidate it all down and say, total tire sales, total revenue, and then total costs. You actually can see every individual one and the gross profit that each one's doing each month. And the reason why that's important is because you can also use this sheet to track what you actually do and then compare it to the actuals. And so then you might want to see what tire is doing the best or worst, what's making the most profit. So if you want to do that analysis, you have to have the data coming in this such way. Alright, so there's all the revenue logic. Next we have, and the easy way is you can just hit this 1 or 2 up here and it will minimize everything. And then you can maximize it. And see all this information on cash flows and loans has to be in there dynamically by month, so we can come up with proper return figures here and visuals, because as well as the business overview, because all these things have to query the monthly and annual tabs. So that's one of the hardest things to do, is get all the data in the correct place at the correct time that makes sense. So that's what I've done here in the monthly and annuals. Now let's check this and make sure. So this should equal the EBITDA, well, the leverage cash flow. So we should end up at 9,345,000 and 9,420,000. The monthly should be the same on the last month. Accumulated cash. Let's see, what do we do here? Annual. And see, this is, now this should tie out. Let's go to the EBITDA here. So it's 24,486, and the monthly EBITDA, I was trying to see what's missing here. $24,486, so that all matches. So what's going on with our cash flow? Year 1 leverage cash flow should be $18,961. Let's go to the monthly. 18,961. So what am I summing up here? It should be 18,961. Wait, it is. Oh, I was looking at the wrong number. This 9 million was just from that month. Okay, so 18,961 and 18,815. 18,815. Perfect. So that means all the numbers have to be right for those two numbers to be right. So perfect. So monthly is all synced up with the annual. We've gone over the revenue assumptions. Now the cost. So the cost I've tied in, administrative. We got CEO, district managers, store managers, sales guys, mechanics, equipment leasing, sales tax, rent, other costs. Now, I wanted to make this kind of big because you really do want to separate all this stuff out. If you have a fairly, maybe 2 to 6 stores, you're gonna need all these spaces. You can always, if you have more stores and not enough spaces, you can always consolidate down. So you could say, well, if I got 3 district managers, what is my total district manager cost each month? And so in that case, I could just put district managers here, and then do 15,000. Whatever the cost is for all 3 each year, their monthly cost. So this is saying every year their monthly salaries are going up. Same with well, did I increase everybody's? Yeah, it looks like everybody's going up. And you can also do the month that you plan on them starting. So if you start with a smaller operation, you can slowly scale it over time by using these month start drop downs. Then we've got our startup costs. So this is the money that goes out before you can even do anything. So a building, if you're buying a building, equipment, you've got all tire racks and everything else. Tires, you could buy inventory and parts, displays, and anything else. We got up to, what's the total count here? 35 possible inputs for startup costs. Then we've got one-time costs. So the only difference between these one-time costs and the startup costs is that they may happen throughout the 5 years. So if you plan on doing projects with your ramping, if you ramp up the business over time, you could have one-time costs that don't flow monthly, but you want to represent that cash need at some point. So you can pick the month, title it here, and put whatever amount, and that will all flow in to the monthly and annuals. You can see where's our one-time costs. These are fixed monthlies. Here they are. So whatever your one-time costs are, they flow into this spot, and accordingly flow all the way down to the leverage cash flow and non-leverage cash flow. Then I finally added a helper calculator. So this is if you're trying to do your revenue assumptions and figure out what your monthly count is for all these sales types. It's just a simple, you put in your count you think you can do per day, and then the amount of working days in the month, and then that gives you whatever total. So say if we're trying to figure out, if we're in a revenue assumption, we're trying to figure out how many Type 1 tires we're going to sell in 2018 per month. We can say, well, if we sell, I don't know, if you sell 2 a day, or let's say we sell 4 a day, that means you're going to be at 104 a month. So this 104 is where you would just plug in to the revenue rate into this whole matrix, whichever, for the corresponding tire and the corresponding year. Same goes for parts and accessories, same exact logic, and then same exact logic for repair work hours. Then each loan is, I think I told you this, so you just doing your finance amount, loan term, starting interest rate, payment per year, and the date this starts, and then it flows through. Put this to 0 for now. And then that's it. That's all the loans, and you have your validation of months, and then instructions here to help out if you need further. So I feel like, this model really has taken everything I've learned over the past a couple years doing business models like this on my own, and really put everything together and made it super clear and easy to use, as well as display information to potential investors or to run scenarios for yourself if you want to do an auto shop. And we've got a really nice set of displays you can use for PowerPoints, and as well as just trying to prove your business case and also value it over a 5-year period. So that covers everything I've got. This is definitely going to be a upper tier model, so $125 one-time fee will get you this model. And to purchase it, just go to smarthelping.com to the page for the auto shop, which the link will be in the description box below, or you could just click on financial models tab at the top of smarthelping.com and just find it. I'll have a link to it in the well, I could just show you. It'd be easier. So here's smarthelping.com. Here's financial models. I'll probably have it in industry specific, so it'll be right on top here, and it'll say auto repair shop, auto repair and tire shop. So if you do pay that $125, I will send it to you. And then if you have any specific information that you need to see, or need any specific assumptions that you need to be have built that's beyond the scope of what I've done, I just charge a rate of $50 an hour, and I'll do whatever you need to do to get it to fit your scenario, or give you functionality to fit what you want to forecast out for your auto shop. And that covers everything. I'm pumped. This is a super intense model. Definitely niche, and I think there's lots of people out there that want to, try to plan out, starting their own auto repair shop. So hopefully this will help, and I'll see you guys on the next one. Hopefully I've only done one for August, so I don't know if I'm gonna have time for another one, but I'll try to get one more out. All right, have a great day.